The next event is a panel discussion hosted and conducted by Richard Williams to talk about the commercial property scene in the UK after the coronavirus pandemic. And we will be talking about the UK Commercial Property REIT, which is quoted on the London market and is another constituent of the UK FTSE 250 index. So without further ado, I'm going to hand over to my two colleagues.
Great. Well, thank you for joining us today. This is QuotedData's panel session on the UK commercial property sector. As you can see, there's now just one guest with me today. There was going to be two, but unfortunately, he was struck down by COVID this week. So this will turn more into a fireside chat, I think, rather than a panel discussion. But we'll be looking at, like I said, the UK commercial property sector as we sort of come out of COVID restrictions and hopefully be getting back to some normality. What investors should be looking out for from the property companies, really. So I have with me today one of the largest listed REITs, UK Commercial Property REIT, Will Fulton, the fund manager of that Aberdeen fund. And I think what the pandemic really hit home to investors was the importance of resilient income in the property companies. We saw dividends suspended at the height of the pandemic as tenants couldn't or wouldn't pay rent to their landlords. And obviously that had huge implications on the property companies themselves, which we'll delve into. But during the last 2 years, there's been several trends that have emerged which have formed and accelerated during the period. The main two being online retailing, which has gone skyrocketed, really, and the impact that has had on both the retail sector and the logistics sector, and working from home and hybrid working, and the impact that's had on the office sector and will continue to have over the next few years as we get back to normal. So let's get into this and cover a few more bases as we go along. So as I said, we've got Will Fulton with me today from UK Commercial Property REIT. Hi, Will. How are you?
Richard, very well, thank you. Do you have a glass of water?
Oh, thank you.
There we go.
So let's talk about the trends that have developed over the last 2 years. I mentioned online retailing and the prevalence of working from home. Yeah. What impact are you seeing on the logistics market, first of all, for online retailing?
Well, actually, it's really linked, and it's huge. And I have the probably fortunate situation of the experience of starting my career in the late 80s. And I think the last few years have probably seen one of the biggest structural changes that I've witnessed. If you think, for some of you, back to the late 80s, Big Bang, the explosion, development of Canary Wharf, offices around the world really expanding out from city centres. Then a little bit later than that, planning restrictions relaxed, and all these retail warehouse parks, which is another interesting part of the market, being developed, and the waning of that perhaps 25 years later. And then now, this absolute explosion in online retail, and that's had impact on both sides. So I'm not going to ask for a show of hands, and I might have done a few years ago, but I could almost guarantee there isn't someone in here, perhaps one person, that hasn't actually bought something online, and more so that their prevalence of buying online has increased. In fact, interestingly, what we've seen, because this has been going on for many years with technology increasing, we've seen over the last year, really, 2020 into 2021, 6 years of expected growth in online retailing has concertinaed into 1 year, with COVID really causing the acceleration of that. And that's done two things. It's dramatically driven the logistics and industrial market. And for any of you that follow commercial property, that's a massive driver there. The company I manage, UK Commercial Property REIT, FTSE 250 listed vehicle, and we have an exposure of 63% to that sector of the market, so really, really significant. I'll come on to that later. Last year, this logistics industrial sector, just looking at that sector of the market, grew by 36% in terms of value, just taking the average, the whole asset class, 36%. Contrast that with probably the worst area last year of the market, shopping centres, which gave a total return of negative 5%. So you can see not only people's experience of shopping online, but it impacts both value on both sides of the equation.
Yeah, and so what have you seen in supply and demand side of things for that sector then?
Again, fascinating. Across the country, there's a 3% availability of industrial and logistics space, which is tiny. Often one might say that below 5% availability in a location would lead to really strong rental growth. So nationally, less than 3%, and then in different areas of the market, even more extreme. So around London, we have warehouses in Wembley. At the end of last year, we bought a different kind of investment for future conversion to warehouse use. A lot around London. It's more extreme there, and it's really driving rental growth forward.
I was going to say, what kind of rental growth figures have you seen in the last year then?
I'd probably give you an example of some of that. Perhaps around 2.5 years ago, in fact, at Wembley, we've got a logistics unit, which is, think of it as 4 football pitches, 4 Wembleys in a warehouse. Marks and Spencer's decided to leave and consolidate outside London. And we relet this to Amazon before the end of the Marks and Spencer's lease. So in my world, in commercial property, capturing rent, either by increases or keeping that rental stream going, actually a little bit like a portfolio of flats, residential property, you want to keep the income coming in. So it showed the strength of the market, being able to relet that. And we did that at £15 a square foot. And that is now worth probably over £20 a square foot. So something like 30% rental growth in a very short period of time, and growing.
So that's the logistics sector. On the flip side then, you mentioned shopping centres and the high street. What's been the impact on that sector?
I'm afraid it's dreadful for that centre, and actually dreadful for many of the economies, the towns around the country. Even here on a sunny day, walking down Upper Street, there were holes in the shops. If you walk up and down, there are vacancies there, and this is probably one of the most vibrant spots in the country. So what we've seen is that people have come out, rents are unaffordable, people are buying goods online, and it's hit particularly those areas, shopping centres and high streets, and some have been really devastated. I took the decision that we would dispose of all or sell our shopping centres some years ago. So in UK Commercial Property REIT, we don't own any shopping centres, and we don't own actually any high street shops either. Our retail exposure, which is mild, perhaps at around 12% of the portfolio, is focused on certain retail parks that I believe in, and that's supported by our very large research team as well.
Yeah, so that's interesting, the nuances within the subsectors themselves. So retail, you have your high street shopping centres, but like you said, retail parks completely separate to that. So it's important not to put retail, everything under one sort of category. So do you want to talk us through retail parks and the investment case for that?
Absolutely, and very relevant again for UK Commercial Property REIT. I should call it UKCM, which is the ticker. It comes out a little bit easier. But actually there, we focused on the parks that have discount retailers in them, people requiring, let's say, lower margins, paying less rent. So rents are low. They sell a lot of goods. They're really popular at the moment. Also bulky goods, which are slightly less easy to buy online. People will drive, pick them up, and we find that these are doing really well. We like to have an element of food anchor, a supermarket perhaps, around about them as well. And one of our most recent purchases, again last year, was Trafford Retail Park, very close to Trafford Centre on Manchester, massively accessible, really strong yielding, and really popular, importantly, with our tenants.
And moving on then, sort of the million-dollar question, I suppose, is what's the future of the office now after this extended period of people working from home, and we're now sort of opening up again, and we're seeing maybe 2-3 days of work a week in the office, the rest at home. What's the implications for offices?
Significant as well, and I think that's the interesting thing of being a diversified property company. So we're not a one-trick pony. We're able to look across all of those sectors and invest across all of those. Some years ago, I sold out of London, principally at that time as with thoughts of Brexit, where we felt Brexit would stymie rental growth there. And we saw some interest. We sold out of our London offices, which was a really good thing then. We don't have so many offices, again, about 12%, but we're quite interested in that market now. And it's probably one of those that is about to be most polarized. So go back 3 or 4 years, and it was about retail, industrial. I think that's quite obvious. Now the office market is becoming really interesting. And I find that tenants, they are taking space. People do, by and large, want to come back to an office, but absolutely not in the way they worked before. So in our offices in Aberdeen, we're embracing agile working, which not only involves my fashion sense, which you may have your own views on, but it allows people to choose when they want to be in an office, to meet people, to collaborate, not necessarily just to come in and sit at a desk. And think about that in a London context, with a really expensive commute, often for people, and also the time that it takes, being able to choose, being in an office maybe a couple of days a week, 3 days a week, and then being at home to fit in with arrangements is really important. What that means, linked as well to ESG, which, Richard, I know you want to talk about, the issue of environmental, social and governance, so important to many investment classes, but particularly in the real estate world where we have real assets producing carbon. Tenants have become far more picky, and they're focused on the very best offices. They need less space, but they want that space to be very good. And they can afford to pay good rents for the very best space. So the market's splitting, I think, to the very best offices, which have strong environmental credentials. They need to have good amenity around them, so whether that's being cooked for in your office or being able to walk around and find places to eat, cycling provision, urban cycle highways in London and other cities, transport hubs. Finding somewhere that's easy to get to and easy to work in is increasingly important.
Yeah. So how would an investor looking at your portfolio or one of your peers' portfolio be able to tell that the offices have these credentials or don't have these credentials? And how would they tell that? Do you have like a fact sheet with all of those types of things on? Or?
In fact, it's not always that straightforward, and it's evolving. So I would encourage anyone, please, to read our interim report and accounts, or more interestingly, when it's released quite soon, our annual report and accounts, which goes into more detail. But if you're observing the market, it's not always straightforward. Things that we're looking out for more and more are the energy ratings of these buildings. So much like if you buy a fridge or a television, I'm sure the audience knows this, fridge or a television will have an A, B, C, D, E, F energy rating on it. A property has exactly the same thing, an energy rating. And there is a new regulation that's drafted coming into force in 2027, particularly as a crucial point, and 2030, where any commercial property has to be rated A, B, or C. And there are a huge number of assets across the country that simply don't meet that standard at the moment. So, Richard, you mentioned to me, I think.
Yeah. So, I mean, this is a big thing that's on the horizon about the EPC ratings, energy performance certificates of buildings, and regulation is going to be coming in that stipulates every commercial property building has to be, is it B by 2030?
B by 2030, that's right.
And C by 2027.
Yeah.
And the implications for the sector is going to be huge, both sort of the capital expenditure to bring buildings up to that standard for landlords like yourself, but also if they're not at that standard, you won't be able to rent them out, will you?
You won't be able to rent them out, and I think the capital expenditure point is really important there. So we will be disclosing these ratings, and I think if you're looking at investing in this sector, be really careful and do pay attention to it, because particularly in the office sector, it can be very expensive to recondition offices to replace all the heating, which is a large part of it, and convert them to make them compliant. So at the moment, we own very, very few offices. I'm quite interested in the regional office market because I think people are coming back to use that a little more quickly, but only in either offices that are best in class already or offices that we can buy, let's say, very cheaply with the specific view to convert them if they're in the right spots, and we can take shareholder capital and convert it and improve our income and capital return.
Okay, cool. So you've been on the sort of acquisition trail recently, buying up assets. What do you look for? What are the fundamentals that you look for in the real estate that you buy, and hence what investors should be looking for you guys to be buying?
Okay, so historically we've been, for the last 5 years, transitioning away from retail, selling shopping centres, selling some offices, into industrial. The process is twofold. At Aberdeen, we have a very experienced research team in property and real estate who actually have a very good track record. So we use that. They blend macroeconomic conditions, interesting to think about what's going on with inflation before the war in Ukraine, but also with that now. So we've got a lot of insight coming from a global macro basis, condensed down onto a property level. And then I and my team blend that, and on the ground, we converge what we're hearing on this macro basis with assets that we think meet the conditions that we want to buy. So offices, location still really important, amenity and so forth. EPC increasingly important, the whole energy compliance argument. And at the moment, industrials have led the way. I mentioned this really, really strong return, and it's great to have a huge position, 63% of the portfolio in industrial and logistics. But we reckon that there'll be a merging of returns going forward across the sectors, and a splitting from the good and the bad within each sector. So a good retail park will do well, a bad retail park will do badly, a good office, select part of the market, will do well, vice versa, and actually the same in the industrial and logistics market. Income becoming perhaps more of an important play in there. The industrial and logistics sector is very low yielding, offers the prospect of very strong growth, so it's important to be in the right place, wherever that is. And so our buying activity has been quite diverse. Earlier in the year, we added to our university accommodation stable. We had funded the development of a new block in Exeter University, which has the advantage of location, where students will be able to arrive and literally drop out of their bed and go to work in lecturing, which I think will be really popular. Really strong environmental credentials. And this year we funded a second one in Edinburgh. Edinburgh is top 30 university globally. So again, really, really strong performance, really attractive for students. Both of those coming on stream for this academic year. So these we invested in as operating income. We're not going to put a long lease on them. We're going to directly let them to the students, and we think this will give us more income and better prospects to capture growth coming through there.
Well, that's a interesting sector of itself, the student accommodation market, with well, for many different reasons, but we've obviously Brexit and EU students numbers being down, obviously with COVID and the restrictions on travel on international students. So what's your thinking there?
We've very carefully selected the cities. So both Exeter and Edinburgh have a big draw of UK students, so they're less exposed to Brexit or global movements, and already our take-up is good. They're phenomenal universities, very low vacancy rate, if you like, in that stock. So by building new stock in the right space, we've almost taken advantage of the COVID environment to come in more cheaply and have operating income from probably two of the best student assets, I'd say, in the country. But not only there, so we bought a retail park that I mentioned at Trafford at Manchester, and two really interesting assets towards the end of the year. One in Leamington Spa, and I don't know if the audience know Leamington Spa, but it's nicknamed Silicon Spa, which is maybe news to some of you. It has a huge gaming industry coming out of Coventry Cathedral. So people often think Oxford and Cambridge as the centres for life sciences, but actually Leamington has got quite a big part of that. So we invested almost £100 million in a multifaceted asset, which is some warehousing, let to the NHS, who've got lab space there. We have a big social media provider about to come in, and some other areas we can build on. Second one on this, and the last of our 5 investments, was actually not at home in London, at Hanger Lane, on Hanger Lane Gyratory, very close to a part of London called Park Royal, which is actually Europe's most successful and biggest industrial and logistics hub. Fantastic for last mile delivery. So actually we haven't bought an industrial property. We've bought a very old office building there, which is leased for 10 years. It has inflation linkage in the rent. So we bought this at a yield over 5%, which is a million miles away from what it would cost to buy, say, it's sub 3% an industrial property. It's well let. We're going to take this growing inflation-linked income stream, and then at the end, the site value, we think, is worth the same as we paid for the whole investment. So there's a fantastic opportunity to convert into modern logistics space at the end of that. So different styles of investment going on across different sectors.
Yeah, and you mentioned their inflation protection. Obviously, that's a massive topic at the moment, with inflation sort of hitting 8% in the next few months and even higher later in the year. Property is seen as a protection towards inflation. Do you want to talk through the inflation protection that normally comes in leases? They're sort of capped and collared with upper and lower limit on the annual inflation on those. Do you want to talk through that and what your portfolio is looking like for inflation protection?
Absolutely. A really important part, and I'm sure to any potential investors across sectors, really important. Maybe the first thing to say is that it's not automatic that all property will give an inflation hedge, but we do believe, and I can see it, that rents are linked to inflation, and they're linked in 2 ways, actually. They're linked by contract, where we can write into a lease there's an RPI or a CPI inflation linkage. But thinking about what's going on in the world at the moment, before the war, we were predicting inflation was going to be rising, peaking, and then falling off towards the end of the year. That has been exacerbated, and I'm sure from many other speakers you will hear that as well. So often those, in fact, almost always, a tenant signing an inflation-linked lease will put a cap, as you mentioned, Richard, on it. And the average is probably a cap at about 3% per annum. So inflation is higher than that at the moment. I don't want to sit here and predict where inflation will be for this year, but it's a really difficult one to predict. And if it keeps persistently higher, then some of those caps will bite, and you wouldn't be buying inflation protection. In my portfolio, UK Commercial Property REIT, we have around 26% of our income on a mix of fixed increases or inflation linkage. So we do diversify, and we do take some of that inflation cover. But the other really interesting part is the assets that we buy. So what I have seen and our research shows is that really good industrial property, and we have a lot of this around this powerhouse of London, industrial estates, 4 industrial estates in London, and warehouses at Wembley and on the M25. We're seeing that the natural growth in rents, with this such a small supply, really strong demand increasing because of the war, as supply chains shrink, people want to stockpile goods in this country. It's just a massive driver. Then the natural rental growth that we experience, say at our Wembley asset, outstrips inflation and keeps going. So 2 kinds of protection: inflation linkage through a contract and a lease, but with a cap, and then the natural, provided that the company you invest in is invested in the right places, inflation protection through demand from tenants wanting to take space which is in short supply.
Yeah, sorry, I'm just curious, just conscious of time. We're getting on towards the end of our panel. So there's a couple of other things I wanted to talk about. Obviously, your company is a generalist property, so you're more diverse than the specialists. And there's been a bit of a divergence between specialists, especially in the logistics sector, having premiums sides, and the more generalist diversified funds have been on quite wide discounts. I think you guys were on about 19% last time I looked, which seems a bit unfair given that, like you said, 63% in logistics, plus the income growth potential that you've got in the other sectors as well. Do you think you're going to say you're unfairly undervalued, but why do you think that is? Why do you think investors aren't seeing that?
So it's good of you to say that, Richard, as well. I think very careful not to give anyone any advice or anything like that in that context. But if you look at an industrial logistics specialist REIT, they're trading on mild to quite strong premium at the moment. So the value that you buy the shares, of course, higher than the portfolio value, and that's predicated on a belief rents will grow, values will grow. These are getting very expensive now, though, in terms of the underlying assets. So there has to be quite a lot of belief in that rental growth. Now, some will have them, some may not. I believe in our portfolio. I think we're in the right place and we will have it. But it's 63% exposure to industrial and logistics. So this premium rated kind of stock. No shopping centres and no high street retail, which is a little bit of a pariah at the moment, and a very modest office and retail park exposure. I think it's interesting that we are valued at a discount, so price that you buy the shares below the value of the portfolio, and I leave it to you and the audience to take any judgment on that. But it is quite interesting. I think one last thing, we're definitely not a generalist, just to be clear. You used the word diversified as well. So my job is not to find a benchmark and blindly follow that benchmark. So our exposure to industrial and logistics grown over 5 years is well stronger than a property benchmark. And looking at our property portfolio, we've outperformed our benchmark over all time periods. So we do well there. But it is interesting on this bit. Part of it is awareness. It's brilliant to be able to speak to everyone today with you, Richard, about that. And I think it's maybe just people going into this new world where having a little bit of diversity in a portfolio is going to be a good thing. Some of my colleagues talk about us as a one-stop shop. I don't know if that's an easy way to think about it, but I'd say a one-stop shop with a lot of intelligence and thought going into how that portfolio evolves and is diversified. Our NAV total return, for instance, was 21.5% over the last year, which we were very pleased with. And we have a portfolio where we think is interesting. We just to finish, we raised our dividend by 16% recently over the previous quarters. We never actually suspended our dividend. That point you made at the end, we've continuously paid a dividend through COVID, although we dropped a little bit, and we're increasing it now. So quite an exciting place.
Are you back up to? Sorry, are you back up to pre-COVID levels of dividend?
We're not at the dividend. We've adjusted the portfolio. No, we're not. But we're focused on, and we've indicated, the board have indicated that they're hopeful that with everything that we're doing in the portfolio, we could see a growing dividend, which I think the the market would reward.
And investors have various ways of getting exposure to property, but two of the main ways is through open-ended structures and closed-ended, like yourselves in the listed sector. We have quite strong thoughts on the open-ended sector, the liquidity mismatch, and that we've seen many times the gated funds and things like that.
Absolutely.
What's your thoughts on the structure?
So in a nutshell, because we're probably on time to finish off, I'm a massive fan of the closed-ended structure, the investment trust system. It allows us to invest all of our money when we want it. We don't have to keep a buffer cash fund to deal with redemptions, and we're not beholden to the gating or the closing of open-ended funds. My experience, though, has been that many of the wealth managers allocating, we're having a lot more conversations with wealth managers looking to say, I understand open-ended, I might have 50% of my money there, 50% of my money or whatever in a closed structure, but a lot more interest coming into it. I think it's a really interesting route for a manager of real estate and for an investor in real estate to deploy money into commercial property. So a big fan. Of course, UK Commercial Property is a very big, very liquid, diversified vehicle listed in FTSE 250 to supply that.
Okay. All right. Well, time's up. So thank you all for joining us. I'd just like to say QuotedData have a village at the front of the hall. If you come along and look at that and sign up to our research, that'd be great. Thanks a lot all.